Good afternoon, and welcome to Making Sense of It All. Traditionally, my opening comment would state that we were the last panel holding you up from the cocktail reception. Well, times have changed a little bit, so I can only hope that each one of you have a glass of something ready to celebrate the ending of yet another fantastic conference. For those of you who do not know me, my name is Jonathan Lombardo. I am head of unit for Northern European sales at Eurex, part of the Deutsche Börse Group. I am currently the chairman of ISLA. Please allow me to introduce my panelists. I will hand it over to themselves to actually make their introduction. So I'll start with Marat.
Seen me before today, if you connected to the conference.
Exactly.
My name is Marije Verhelst. I work for Euroclear and I head up the business development team for collateral management.
Fantastic, thank you. Ian? I think we can't hear Ian.
Hello, can you hear me now?
Yes, perfect.
Hi, sorry. My name is Ian Mckay. I'm the global post-trade product owner at Equilent. I think quite a lot of people have wanted to meet me in the past.
Okay, thank you. Matt, over to yourself.
Good afternoon. My name is Matt Puskar. I'm responsible for the securities lending operations at Vanguard.
Okay, and finally, Ricky.
Hi, I'm Ricky Smith. I work within JP Morgan within the collateral services business, and some of you would have seen me yesterday as I co-chaired and hosted the first day.
Great, thanks for that. So, the thought of this panel is always to find the common thread or message that comes from all of the sessions over the last 2 days. And I can honestly say that generally what we heard, at least from this panelist point of view, was regulation, specifically CSDR, ESG, and standardization, digitization, and digitalization. As we learned from the last panel, there are two significant differences. So why don't we dive right into it? So the first question I've got for the panelists are we back from the abyss? We've heard a lot about new markets, optimizing supply for better alpha generation, a stronger move towards collateral trading. Do we collectively agree that we have come out of 2020 stronger and we're ready to trade? So with that, can I please start with Ricky?
Yeah, thanks, Jonathan. So I think from my perspective, as we heard on the first panel of the event, what we witnessed in 2020 was really a game of two halves. And in the first half, we saw extreme volatility and large drops in valuations across global indices. Whereas in the second half, and mainly towards the end of the year, we saw these equity valuations reach new highs, and which is off the back of the result, the news of the vaccines being rolled out. This was also evident within our mix of collateral that we see within our tri-party program at JP Morgan. So traditionally, we see a mix of between 60 to 40 in favour of equities. However, during the peak of the pandemic, this had flipped to a 55 to 45 split in favour of fixed income before returning to the pre-crisis ratios during November. And as mentioned as well during the trading and business panel, some markets did introduce short selling bans, but not all did. So what we observed within tri-party was an initial stable high value of collateral requirements being topped up with fixed income assets as valuation of equities depreciated. And again, as you mentioned, as anticipated, right, ESG was a feature of many, if not all, of the panel discussions over the past 2 days, right, and increasing in significance, both really in terms, and we see that there was a need from the borrower community for significant transparency, also a call from the industry view to get an industry view and guide from the lender side. I think this will no doubt sort of dominate conversations, will be topical throughout the remainder of this year. I think it's vital as an industry that we look to work cohesively to address these pertinent points as they arise. Also, new opportunities in both asset classes and markets continue to be the focus for both sides of the trade. And again, as we heard, the lower interest rate environments creating new lending opportunities for clients looking to increase returns. However, it's also important to remember that the key to any new market development is critical mass and coordination across the industry. In addition to this, there must also be supply and the ability to take the collateral. And quite often this is overlooked. So just something we need to think about as we move forward.
Fantastic. Thanks, Ricky. Marat, anything that you'd like to add?
Yeah, no. Similar views here on our side. So we've also seen on our side, on the tri-party side, balances increase a lot in line with volatility on the tri-party securities lending side in March and April, then to stabilize somewhat, and then another increase towards the last quarter of the year, and to stay there. So that's indeed quite positive. Also, I think whereas the start of the pandemic, a lot of the discussions on, I would say, new trade opportunities had been put on hold. For example, the whole discussion on pledge, all that discussion is back on the table now, and there's real momentum now to really start to work on those opportunities. In the same way, we're onboarding new types of lenders, buy side, and we're also having discussions on opportunities in other asset classes.
Fantastic. Thanks for that. Matt, from a buy side beneficial owner perspective, I mean, what are you seeing? What are the trends? I mean, can you kind of agree that we're out of the, coming out of the curve back up on the upward trajectory model?
Yes, absolutely. I think there's two aspects to the original question that you asked. Are we coming out stronger? And the answer is absolutely. We're going to come out much stronger on the back end of this. We reached full capacity beyond a lot of our capacities, but we came through as an industry, we came through as individual firms, and now looking at that, we have new capabilities that we never had before. Although we're coming on the back end of a truly amazing year, some of the headwinds that we're facing, the market's facing, has been very interesting. We would have thought the worst was out of it after the pandemic, and then we saw a lot more volatility coming in January and in early February. Just constantly new challenges, both for the individual firms trading, but also operations. With that being said, the industry has come together. We've built new capabilities. We are absolutely stronger, and I do think that we're ready to tackle the challenges that lie ahead.
Okay, great. Thanks for that. Ian, is there anything you'd like to add from a post-trade perspective? I mean, are you seeing increase in volumes over the first quarter?
Well, I think to echo the points that were just made there, if you kind of take a broader look at our services, obviously we've got the trading platform. We saw the big volatility that happened in March and April time of last year. And I think it's testament to probably all of the infrastructures that are around that actually they were put under a tremendous amount of strain. Firms were also trying to grapple on the backdrop of working from home, and the stability and the robustness of the infrastructures all stood that test of time. So I do think as a kind of industry and market infrastructures, we came through that particularly well. I do also concur with certainly clients looking at new markets. We're certainly seeing that in conversations that we're having with clients, also with some of the new markets that people are looking to put trades onto our platform as well. So that is certainly something that we're taking a look at. And again, from a collateral perspective, there is interest in terms of doing some more from the collateral point of view. We certainly see interest in conversations in terms of building out that trading platform. And I think, as a consequence of that, there is a lot more activity that's kind of fed down into the post-trade platform. But I think we'll generally kind of cover off some of those things a little bit later on with some of maybe the other questions we've got lined up.
Okay, fantastic. Thanks for that, Ian. So let's think, ESG was another massive topic that was echoed through the 2 days. And so, I mean, do we feel that the market is prepared for this impact? What velocity will the market need to adapt for collateral, trading, reporting requirements? Do we have the sufficient resources? And do we feel that post-trade technology can move us in the right direction quicker and more efficiently? So can I start with Matt, really, on this question from a buy-side perspective again?
Sure. I would say the buy side has a bit more of an advantage than some of the other aspects of the industry, for sure, especially over the general agent lenders. We know what our strategy is going to be. We know how to implement our strategy, and we know how to make sure that our programs are in tow with that. I think it gets much more difficult as you're moving down that curve and you're getting into the agent lenders who now have to cater to multiple clients across the board. So for instance, we know what we want to do as a program. We know what we need agent lenders or some of the other participants to cater to, but a lot of what the agent lenders do is they make sure that they can operate at scale. And the more customization you have, the less scale that the agent lenders get. And so I think that's one of the bigger challenges that they're going to have to work through. And I do think that's where a large part of the post trade and some of the other interconnectivity with the vendors are going to come into play.
Okay. And Murad, maybe you want to bring a little bit of the tri-party collateral into that. How is it affecting you? What do you see in that space?
Yeah, I think it's a very similar discussion. Are we going to go for mass customization or are we going for standardization? And there was a lot of discussion on the need for standardization. And I think as a tri-party agent, that's really what we need. We need to know we can provide different solutions to the market. We can provide the choice to work on the basis of indices to include assets. We can provide possibility to exclude assets. We can provide the possibility to work on using ratings. That will be a little bit more work, but it's possible. But the whole question is what is the need of the market? So I'm happy to hear that there's a lot of discussion on standardization, and that will certainly help the tri-party agents to cater for the right solutions. But for sure, what I hear clearly is we need transparency, and going for long lists of exclusions or inclusions is not going to be scalable, and it's also not going to be good for transparency. So that's the challenges probably that we have. Yeah.
Thanks. And Ian, I mean, working at, a post-trade organization, heavily weighted on cutting edge technology. How do you see, where do you see your guys stepping into the equation? How do you make the market get to where it needs to be quicker?
Yeah, it's been interesting actually listening to the ESG debate over the last couple of days. I mean, clearly, I don't think anyone has underestimated the amount of impact that it's actually going to have on the industry. And it's quite listening to see how people were kind of talking about the fact that there's still quite a lot of analysis that is still being done at this moment in time. I think the kind of two obvious places where people seem to be looking at was around collateral, which Mckay has kind of alluded to specifically there. And it looks like there was some element of functionality there, even if it was a bit of a blunt instrument at the moment, and it needed to obviously be finessed as it kind of progressed forward. But clearly, other things were focused around the recall processing, which was obviously going to help in terms of shareholders' rights and the whole kind of voting process as that kind of goes forward. So I think really from our perspective, really the kind of infrastructure in some ways in terms of a workflow is there. The kind of view that I took in regards to this is that we do need to take a kind of step back and really understand what is going to how ESG is going to evolve. Are we going to have to do some more bespoke or customized offering to be able to support clients in regards to that? A lot of the dilemma it looked like with the market was that it was trying to convey rules into the ESG program, and we're quite not at that stage yet. And I think that from our perspective, we obviously quite like operating in a rules-based environment. It makes it a lot more easier for us to be able to kind of do that workflow management and that processing. So I do think that's a little bit of the kind of dichotomy that's going on at this moment in time in terms of how we support it. But I think, if I was to take a look at it, if clients were looking to do something now, they would be able to leverage off the infrastructure that was available to them. But I think it's rudimentary, and I think we're going to have to kind of expand and work with our partners, and that's the industry bodies as well as clients, to be able to come up with that optimal service. And I think we've got to move ESG from being a kind of bespoke new entry into something that's quite vanilla processing. And and I think nothing frightened me of the way that we can do this. I think it's just the way that we just have to help kind of alter some of our offerings to be able to support that and standardize it.
Okay, Great. And Ricky, I mean, from your perspective, have you started to do an impact analysis on what it means for your program? How are you going to get there as quick as possible? What are the hurdles? What are the obstacles that you see facing, yourself?
Yeah, I think the first one is with regards to what again has been repeated on numerous panels, right? Is that ESG means different things to different people, and not just the ESG itself, but when you break down the constituent parts, E, the S, and the G, each one of those means different things to different people. I think what doesn't help at the moment is the plethora of ESG data providers that are out there. There's over 130, I believe, today providing scoring related data, which when you look at it, you've got to then be plugged into at least one or two providers to get critical mass and coverage of assets that are in your universe. So that's really where the major challenge comes. Now maybe with greater push for regulation that we're seeing for these ESG data providers to be regulated, we may see a consolidation of the providers within the market, which will come as a great benefit and may help towards some form of commonality and standardization. But I think where we really need to go with this, and it's kind of what everyone's saying. We're saying mass customization, but I see it almost as like an automated customization. So providing a way to, with those tools, to be customized, but in an automated fashion. As we know, they're a bit clunky today. Trying to agree an eligibility schedule between the lender and the borrower, and then having that changed, and an account that's potentially an omnibus account of the tri-party agent is very challenging. So maybe there's also something to be looked at in terms of account structures. Are there account structure solutions that enable you to have that one single eligibility schedule, but underpinning that, one underlying exposure with the borrower, but underpinning that a set of eligibility rules that's specific to your underlying beneficial owners? I think there are probably clever solutions that we can look into just outside of the set eligibility to.
Yeah, to just add
Okay.
in a
I
little
mean,
bit further.
it sounds. Sorry, please go ahead, Matt.
I was going to say, to add a little bit further into what Ricky and Ian said there, I think a lot of the solutions are things that we were naturally going to work towards anyway. We want to get more efficient with our recalls. We want to get more efficient with our settlements. We want to get more efficient with our ability to agree a collateral schedule or customize a collateral schedule. So I do believe the push for ESG is going to necessitate some of that and just get us there faster than what we would have been on our own.
Yeah. I mean, it sounds like there's still work to be done in that space. It's not going to be a quick plug and play solution, but it's good to see that everyone is focused and moving towards a common finish line on that. Listen, sticking to the ESG and new market conversation, what we also heard is a lot of pressure from the regulatory world. So CSDR, SFDR, UMR phase 5, 6. Are these going to potentially hinder the new market initiatives? And a question is, do we feel that the buy side beneficial owners are now going to start to feel fatigue and potentially step away from securities lending, which in all reality is an ancillary service? Is there really enough alpha and low pricing points in the post trade space to keep liquidity and the buy side engaged? So again, unfortunately, Matt, I'm going to go with you to start that conversation off.
Yeah, I think you asked a ton of great questions there, and there's a bit of nuance. So it depends on the portfolio. Sorry, it depends on the portfolio as far as whether or not there's enough alpha. And because of the regulations, because of the various things that you rattled off, we have to make choices. We have to make choices on what we're going to concentrate our resources on, how much money we want to spend in each area, where we're going to allocate our funds, whether it's going to be building things with in-house capabilities, using things externally, whether or not the market's going to come with new vendors. I do think there's certain aspects where, is there going to be enough alpha? It depends on if your portfolio is more intrinsic based. If it is, then I do think there'll always be enough alpha for it to be worthwhile. If it's really more of a quantity-based lending program and some of the margins aren't there, especially in a very low interest rate environment, that's when it starts getting a little bit more challenging, and you could start to see some people drop out of the market, at least in the short term. Alternatively, they could be looking for other ways to be able to get into the market, and really using a vendor that could do a lot of those things at scale, take on the cost of those programs, I do think makes it a bit easier. And there are still a lot of the agent lenders in there that can take on the complications of everything that you mentioned and still be able to do it at a price that's palatable.
Okay. Ricky, can I get your comments on that?
Yeah, sure, Jonathan. So yeah, with the wave of regulation, this is where I sort of see personally, for a beneficial owner, the benefits of being part of an agent lending program with regards to securities lending, securities finance. So at JP Morgan, the intention is always to insulate the clients from any potential impacts resulting from regulatory change, just to ensure there's no negative consequences suffered on their behalf. A specific example here is with regards to CSDR. So whereby the intention is to ensure that no cost impact to a client failing sell trade in the market caused by a borrower return, assuming the client has notified obviously the agent of the sell trade within the agreed terms. But additionally, what this has led to, so obviously it's a regulatory change, but additionally we've made investments in enhancing operational processes. So to remove the friction and increase STP rates. So both from an internal perspective, but also from the partnership with vendors. So on an internal side, we've looked at the partial settlement of returns to obviously reduce the exposure to the sales rate. But also with the vendor solutions, we're looking at contract compare, real-time compare, so all of which will benefit the post life cycle and reduce the operational drags currently seen today. And again, any improvement there both reduce the costs and friction, not only increases alpha, but also makes it easier to trade.
Great, thank you for that. And Murad, from a tri-party perspective, all of this is additional work away from your core, tri-party services. I mean, how's it affecting you? I mean, all of these pick and choose of regulation versus, new pricing points.
Yeah, it's a good question. Yeah, I would start. All of those, of course, impacted a lot the way we do business. If I start with CSDR, obviously, as we are an ICSD, the impact on us has been quite tremendous. Not only the settlement discipline part of CSDR, where tri-party is actually shielded, so there the impacts on tri-party are limited, but obviously CSDR as a regulation for us has had big impacts on the way to do business, and a huge focus on the need to reduce credit for us and for our clients. So that has led to big developments to ensure that we optimize the credit usage of our clients. If I then look at I would say the UMR, that's the other one where there has been a big impact that has triggered, on the one hand, business opportunities clearly, because there was the obligation to exchange initial margin for non-cleared derivatives, but it also led to big changes in the way we had to work, as we had to deal with the regulatory deadlines to onboard different waves, and then of course now in the waves 5 and 6, where you have buy-side clients coming on board, not only to receive collateral but also to post collateral, and then also the smaller buy-side clients, where we had to find solutions on how to accommodate the business models for those types of clients, and finding solutions, working together with the custodians of those clients, so that they either could come directly in tri-party or still work with their custodian and have a solution still for the sell side clients as well. So yeah, has been a lot of work over the past years.
Okay, so before I ask Ian a question from a post-trade perspective, I mean, all of that comes at a cost, right? So I mean, all of these additional services, there's got to be a cost consideration that comes bolted onto some of that. And I'm sure that every organization looks at it either from a tiered perspective or just a relationship perspective. But how do you kind of ensure that your pricing point remains in a way that allows the liquidity providers, going back to Matt and Ricky, to keep on playing in that field? And I could pass it over to Ian really quick and then come back to yourself so you can regain your thoughts. So Ian, why don't I start with you from a post-trade perspective, because this is what you guys really offer is, right? It's this efficiency, and efficiency does come at a cost. With all of these additional requests, what does that do to your business model? And then I'll come back to you yourself, Murray, to talk about it from a tri-party perspective.
Yeah, so I suppose if I take a step back and take a look at this, you've obviously got firms when they were talking in the regulatory panel around the issues they have in big programs of work with two massive pieces of regulatory initiatives that have been quite dominant in the securities lending world. SFTR last year, you've now got CSDR this year. And, obviously that's taken up a lot of resources and time to be able to address those. And I think that one of the things that the vendors played a considerable part in being able to help support and facilitate solutions to allow compliance for SFTR. I think if you break it down into three parts with SFTR, you have the reporting angle, you then have the kind of pairing element, and then you have the matching element. And if you take a look at what we've been doing, we try to cover all of that and help clients to get compliant from that perspective. Will again be going hand in hand in terms of CSDR and again providing that transparency, that support to enable clients to be able to achieve the settlement efficiencies that they're looking for. What though it did come across was that a lot of people are spending a lot of time focused on those particular regulatory initiatives, and if you kind of take a look at what you said earlier, Jonathan, does it actually distract or detract people from actually joining all of this kind of compliance to this processing? I think actually the biggest cost when businesses take a look is actually in their post-trade inefficient process. So actually the way that firms can actually recoup the costs that they're actually paying is actually becoming a lot more efficient in the way that they actually do their post-trade processing. And this is the purpose of what the vendors are here for. We have provided products that support each individual life cycle event. But really, what we're trying to do, and SFTR has been a bit of a catalyst, is the standardization of that data, and that's enabled us obviously to be able to offer improvements for clients in this regard. Now, from our perspective, obviously there is costs associated with that in supporting our clients, but actually the value that they get out of it is far greater, because the return that they can get in terms of the efficiencies that they can gather from the compliance to some of these regulatory initiatives, for example, far outweighs any of the kind of costs that are kind of associated with it, and they can really extract quite considerable benefits coming out of actually enhancing the way that they're doing their processing. So I do think that there's opportunities really for clients if they take that broader kind of view, strategic view, in terms of how much does it cost end to end to actually execute and settle a trade, and then they could realize actually the benefit they can get out of it from efficient post-trade processing.
Okay, thanks for that, Ian. Ray, could I come back to you from a tri-party perspective? I mean, where do you see the point here from a pricing perspective?
So it's an interesting question, Jonathan. I think when you look at pricing, well, obviously for any company, you need to always take decisions between investments, and it's also always a risk reward decision, and then your pricing needs to be adapted to that. And I don't think it's any different here. So I think you'll have to choose between you'll have to make always a business case and balance the benefits, the cost, and the importance for your clients. I would agree with Ian that it's not all cost. There are benefits from those projects as well. If we talk, for example, about CSDR, yes, there's a big cost to that, and yes, we don't like all the aspects of the settlement discipline, to say the least. At the same time, I think for the better of the market, to improve settlement efficiency is good for the whole market, and there are definitely lots of benefits that can be drawn from that, and I would see I see that there's really a momentum now to work on those and to improve settlement efficiency across the different markets, and you see that there's discussions there with ICMA, with ISLA, to really make steps forward, and that will be beneficial to the entire market.
Okay, thank you for that. Matt, I wanted to just come back to you with the original question about when does the buy side get fatigued? When is the cost outweighing the benefit? I mean, do you see that on the horizon? Do you see, I mean, I know you briefly talked about you pick and choose of, you know, where you want to make the investment and how you want to move forward. But at some point, you say, wait a minute, this is starting to really get a little bit more expensive than the alpha that I'm creating off the back of my program. How do you adjust for that?
Sure. I don't see that really occurring in the anytime in the near future. You know, the margins that are there for the securities lending program, right, are sufficient to cover the additional costs that are coming through.
Mm.
And as has been mentioned, those costs are typically a bit shorter term because there's other things that come in place that make you more efficient. And so while your costs increase in the short term, right, to make sure that you're compliant with regulations, to make sure that you're doing what you need to do in the post trade, eventually you build up the efficiencies where the cost comes back down in the short term. So it may end up coming to that point at some time, but I don't see it in the near future.
Okay, perfect. All right, so let's move on to the digital aspect, or the so you know we've discussed digitalization, and standardization, and we see that kind of changing the post trade landscape. You know, again, this all comes back to what's the cost. You know, do we see, and this is a bit of a continuation from our last last question, but do we see this slowly eliminating smaller players within the market? So maybe not the Vanguards and the BlackRocks and, you know, the other large asset managers, but are we seeing some deterioration? And, you know, if we're moving towards this standardization, what does that do from the commercial aspect of product offerings, right? If we're all using open source, what's the special sauce that makes one different from the other? So, Ian, I'm kind of going to start with you on this one, because I think, you know, when you look at you know, that lovely word of, you know, interoperability, I think that's something that people like to step away from a little bit, because it means that I'm losing the commercial dynamic. Does standardization and common domain models and open access erode some of your worth?
So from okay, so I'll answer this in a couple of ways. I think the value that clearly we offer is in terms of helping connect to within a kind of ecosystem, a security lending ecosystem, maybe front end trading platforms through to different market infrastructures. So, you know, we happen to connect to tri-party agents, we connect to different platforms, we connect to different post trade platforms as well. So I do think the term of there isn't actually any kind of, let's say, interoperability, interconnectivity that actually goes on between firms, I think is a little bit of a misnomer, because I do think that there is data that's shared quite frequently between institutions from that point of view. Where it goes in terms of data standardization, I touched on it a little bit earlier, but I think that we're actually in quite a pivotal moment in the post trade space. You know, if you take a look at firms, a lot of them have had old historical infrastructures, and it's been a challenge to be able to get that data together for SFTR. Now that data has come together, that a lot of it has been normalized, a lot of it has been standardized, and really now it's kind of an opportunity to be able to take advantage of that. And we've heard about the work that's obviously getting towards a digitization model, and the common domain model. And I do think we'll end up in a common domain environment for sure. But there is obviously stepping stones that kind of go into that particular phase. And I think for in the short term, clients need to extract value like immediately. And what we've worked on is kind of bringing things up to the earlier up the value chain. So actually, you're matching at a point of event. And so what you end up doing is that rather than where the cycle currently works now, firms book something, they send it into a vendor like ourselves. They then have to take it back to rebook the trade and so forth. That reoccurring theme just kept creating break after break after break and never really resolving the issue. Really matching at a point of event actually then eradicates all of the downstream issues. And what it also does do is that stepping stone towards the CDM model. So we have a GEM product, it's global event matching, but that allows us to be able to do that matching at event. And I think that's really where clients are going to extract the benefit from the standardization right now. And I'll go back to the point I made earlier. The costs is in post trade, and if we can actually get that stuff eradicated and reduce the number of efforts, and you only have to listen to what was said earlier. There is transparent now in terms of the number of breaks that firms are seeing, really at a granular level of detail. We've had that for a good couple of years. Really, clients now have to try to take advantage of their standardized data and really look to start to minimize a number of inefficiencies that they've got with their workflow processing currently.
Okay, thanks for that, Ricky. From an agency perspective, I mean, going back to the first part of the question about, are the costs going to eliminate some of the smaller asset owners in your program? I mean, what are the conversations that you're having as some of this regulation is coming down the pike, some of the work that you have to do from a common domain model perspective? I mean, is there a question that these lesser sized asset owners may be affected by some of this cost?
I think if we look at the common domain model, and we sort of recognise that digitalisation of our market produces some heavy costs associated, definitely with the development of such infrastructure. However, is they're able to mutualise the cost by pairing up with other associations, so you get that benefit with the likes of ISDA and ICMA, actually to pay for that development on behalf of the industry. So the CDM is actually an open source, which is a free platform. This then means that the smaller players are not disproportionately paying higher costs to help towards that effort and to make it work. What it does actually mean is that the further IT developments can therefore be achieved and delivered much cheaper. I think the way that we kind of look at CDM, and we're working on this, is that you almost have to look at CDM as it's the road, and then the vendors and the market participants therefore have the opportunities to build the cars to then come onto the road and go down that journey. So we don't necessarily see it as having that much of an impact and a cost from an underlying client perspective.
Okay. So, I mean, it sounds like we're moving everything in the right direction, right? New markets, we could digest the regulatory impact, the digitization or digitalization of the market is making it more effective and efficient. So we're getting more players customized to general kind of playing field, and everyone can participate still at the same levels. I mean, Matt, would you agree with that? That everything seems to be working or moving in the right direction, and we don't really see a massive hurdle in any of these kind of upcoming regulatory requirements or move to open source?
I agree to a point. I do think that a lot of the things that we talked about when you look at holistically add to more efficiency. More efficiency means that you can tolerate the cost better, and that goes in the right direction. But as I'm sure each person on this phone can tell you, when there's more regulation, you have to choose where you're going to spend your money, and that's going to impact some of the decisions that you make. So that may impact what markets you want to get into. That may impact the new product types that you're going to offer, because you're almost forced to spend your money in a way to become compliant. And that does detract from other, perhaps more innovative areas. With that being said, a lot of the things that, a lot of the times the regulations and some of the need drive innovation. And so you have some smaller niche firms, some of the fintech firms that are able to step in and fill some of that void. So it does add a little bit of cost, but it also adds opportunity for various vendors to be able to come in and fill the void. And therefore, I do think it's, holistically, that I don't think it'll price people out of the market, especially not the end lenders by any means.
Okay. All right. Beautiful. Thank you for that. And Marat, any kind of party comments on this last question before I move on to the next? Anything from a tri-party perspective?
No, the point where I see mostly benefits from those new technologies. I don't see them as a cost or a risk of losing the smaller market players, because the automation is going to be to the benefit of all of them. Where I do see a challenge, and we talked a lot about standards and the need for standardization, is how to get to that standardization. And Ian mentioned, with SFTR, we have normalized data, but that was regulatory driven. If you take the example of we tried to develop a standardized GMSLA to allow the easier onboarding of repo, of corporates on repo. It's really a challenge to have firms agree to a standardized GMRA. So standardization means that firms have to give up on their choices, sometimes on their risk parameters, and that's a very difficult discussion with risk management. So that's where I see challenges. It's the same for ESG. Will firms be willing to give up on their own decisions, and will they agree to standards? That's a challenge, I think.
Okay. I know we're kind of coming on to time, so there was a final question, but I'll put it out there, but I'll leave it out there as food for thought for people to think about. Is thinking about trade associations, the alignment of all the trade associations working together, identifying digitization as the key priority that can reduce unwarranted risk and potential enhance post-trade efficiency. How do all of these trade associations, outside of best practices, right? Because that's what trade associations do. One of the better things that trade associations deliver, how do they move the market collectively? And I think, we were going to briefly talk about the working groups and things that we put together as part of the trade association, but I think that's something that we could hopefully pick up a little bit more next year at the next post-trade conference. So as we're closing this one out, I'm just going to turn to all the panelists for their thoughts on what do they believe the composition of the 2022 agenda may look like. So I'll start off with our chairs. So I'll start with Marat. I'll start with you first. Just short and sweet, 20 seconds, no longer than that. Don't worry about it.
Well, I hope next year we'll have real drinks again after the conference.
I like that point. That's very good. Ricky, over to you.
I think just considering both the regulatory and digital roadmap, I think we're still going to be talking about the need for efficient and effective partnership and design partnership across industry associations, as well as vendor groups, as well as other market players.
Fantastic. Thank you for that. Matt?
I'm guessing one of the bigger things that'll be at next year's conference is going to be the untrapping of assets through digitization, especially when it comes to collateral and tri-party.
Great. And Mr. Mckay, to close the session out.
I think it's going to be people slapping themselves on the back, realizing how much efficiency they've saved in their post-trade processing by using the vendor.
Lovely, lovely. Post-trade, digitalization, it's all going to make things a lot easier. So listen, I want a big thank you to the panelists for their insight as to what they took away from the sessions that have occurred over the last 2 days. So thank you very much to the panelists. I believe that you have me for a few more seconds. So as chairman of ISLA, I would like to extend my gratitude not only from myself, but from the board to ISLA the staff of ISLA, the staff of Event Rock for delivering the content and platform. It's been a fantastic event. I'd like to thank the sponsors for their continued support. I mean, they make it possible for us to keep this at a low cost entry point to include all. I'd like to thank the panelists for their expertise. And most of all, I'd like to thank you, the audience, for taking the time out over the last 2 days to kind of spend it with us and kind of add your insight and hopefully take away some really solid thoughts for the remainder of 2021. And the last parting comment I have is that I hope that we could all actually see each other very soon. And going back to Miraz's comment is, have a drink together. So thank you for coming. I hope you enjoyed. I hope you took something away and have a great evening. Thank you very much.